anyone watching us on video tape, welcome to the class, all right? But those who are here live and in person, welcome to, if you're here for partnership tax, you came to the right place, all right, guys? Textbooks. For better or worse, guys, you get the 11th edition. The good news is, completely up to date. The bad news is, you got to pay full price because it's truly fresh off the press. All right, so, and I know inevitably people will ask me, can I use an earlier edition? In this case, I would say you're really going to do it at your peril. They made some real changes because of the 2017 Tax Act. So you're going to have to splurge. Not my choice, but it will be up to date. So bear that in mind. The code, 2019 or 2018, as long as it has the Tax Act of 2017 in it, I'm okay. So it doesn't have to be 2020. And the publisher always has like a year in advance. You should bring your textbook and the code regularly to class. There's a lot of supplementary textbooks out there. I just brought one tonight. This is one of my prior professors wrote, Noel Cunningham. A lot of students like this book. So this one, you don't really need the newest version, but I won't stop you if you decide to get it. So those are some of the books that you should have. Logistically, we meet Wednesday nights for the next 14 weeks, except I know some of you are going to be disappointed. The day before Thanksgiving, we will not have class that day. So when you do your 14 weeks, just bear that in mind. The day before Thanksgiving, spiritually we will be here, but physically we will not, okay? Our textbook is, these authors have been through it. And I've worked often with this gentleman. This is a new author, Brett Hellwig. Very nice guy. He's now dean at the University of Washington. Solid citizen, good guy. Brought the book up to date. Very popular textbook in the area of partnership tax. So this is not something that has been just used once. It's been, again, one of the most popular graduate tax textbooks around in this area. In terms of your requirements, guys, you're going to have to, usual stuff here, we're going to do a midterm, we're going to do a final exam, open book. One question I had is some people wanted to know, can they get a PDF of the code? Just keep in mind, it's an open book exam, but nothing electronic, okay? So you should have hard copies of the textbook, hard copies of the code, you can bring notes, whatever the case may be. As the semester unfolds logistically, most of you know I try to be religious about returning emails and phone calls. If you don't hear from me, usually within 6 to 12 hours, just resend an email, put high importance, whatever the case may be. My first priority is you guys, so we got to make sure you really master partnership tax. Be forewarned. Over the years, people will say, what is the hardest tax course in the program? You know what the winner is? Partnership tax, okay? So you guys are in for quite a ride. I am too, because it takes a lot of energy to get the information across. But accordingly, guys, you have to put in the time, effort, and energy to make sure you master this material. This will not come through by way of osmosis. You cannot just put this book under your pillow and assume that somehow you will absorb the information. So you got to put lots of hours in. You will be rewarded. How will you be rewarded? What is probably one of the most popular business entities for people who engage in business in the United States?
Partnership.
Well, you might say corporation, but let's put it this way. Most people will not engage. Your go-to clients, guys, I hate to say this, is not going to be Facebook or Google who's going to call you up and say, can we use your tax services, right? It's going to be the smaller clientele. The smaller clientele, largely, not entirely, are going to opt for either a LLC or S corporation. All right, so just know that in advance. So your time tonight, your time every Wednesday, the time you spend outside of class will be well spent, because this is going to be material that constantly folks are going to ask you questions about, right? And this is not something, no offense, I hope no one here will take offense at this if you ever worked or currently work for H&R Block, but the folks at H&R Block are not going to have a great command, if any command, over this kind of material. So you really have to, this is where your expertise comes in, all right? So I need you. All right, so quick overview of the course, because I think it might be worthwhile. Just take a look at the FARs for 5 minutes, and then we'll get into tonight's material. Hopefully you guys have gone down the path and saw that I've sent several emails about the reading material for tonight. If you didn't have a chance to read it, so be it. But we're going to try to cover the first 60 or so pages tonight. I have a very ambitious agenda for this semester, all right? All right? Hear me on this. So just take a look. I mean, those who've had corporate tax, the good news is this course, like corporate tax, follows the life cycle of a partnership, okay? And that's what we do in corporate tax. We follow the life cycle of a corporation. But here, Chapter 1 just gives you an overview of how partnerships and partners are taxed. If you don't absorb everything in Chapter 1 tonight, that's probably going to be true for most people, is that it'll be a lot easier to read Chapter 1 once you're through most of the course. There's lots of concepts that may seem fresh and new. Chapter 2 is where we really start hitting the ground running. It deals with formation of a partnership, okay? Formation issues. This is the birth of a partnership. Very, very exciting, okay? Chapter 3, operations of a partnership. Now we're going to operate the puppy, all right? So that's Chapter 3. We're going to learn about that. One of the key differences of partnerships versus corporations are allocations, partnership allocations. So we're going to spend quite a bit of time talking about partnership allocations, see what can and cannot be done. So you're going to see the allocations themselves, and then you're going to see safeguards, okay? Because people look sometimes to play games with partnership allocations. So we're going to learn about ways that Congress has instituted to limit income shifting. Partnership liabilities, very, very tricky area. This is Code Section 752. We're going to get a glimpse of this tonight, because when we talk about partnership formations, often contributed property has liabilities. They have liabilities. The properties are subject to liabilities. So even though you might say, gee, why are they in Chapter 2 dealing with partnership liabilities? We're going to cover that in Chapter 6. Fair question. But the reason is, even at formation stage, you have to consider partnership liabilities. It's not something that can be swept under the rug. All right? And then there's issues about when you compensate partners, how that should be treated for tax purposes. Anytime you have related party transactions, many of you are familiar that, for example, if a father sells his daughter property at a loss, there's code sections like Code Section 267 that disallow the loss, right? Well, when partners have transactions between and among themselves, Chapter 8, as you would anticipate, puts in limitations, right? That partners and partnerships not willy-nilly engage in transactions between and among themselves. So Chapter 8 and Chapter 9. Chapter 9 deals with what happens if you sell a partnership interest. Many of you know Code Section 1221, right? Code Section 1221 deals with what is a capital asset. Well, what is a partnership interest? If you own an interest in a partnership, what kind of asset is that? And we will see when you sell a partnership interest, it may give rise to both capital gains and ordinary income. There's going to be two different code sections at play, 741 and 751. So this is going to have a hybrid kind of approach. Next, we're going to talk about operating distributions. When a partnership makes a distribution, we know when a corporation makes a distribution, and by the way, periodically I will mention corporations, guys. You're not responsible for exam purposes, anything dealing with corporations, but it's in my DNA to talk about the juxtaposition between corporations and partnerships and compare and contrast them with the aspirations that by making that comparison, for some of you who've had corporate tax, it will refresh fond memories. But even if you haven't had corporate tax, just to get a sense of the different possible tax treatments. So when corporations make distributions, some of you may recall Code Section 311. Gains are recognized, losses are disallowed, right? When corporations make distributions, and the shareholders themselves may have tax, right? You remember Code Section 301, C1, 2, and 3. Okay, can give rise to dividend income, return to basis, capital gain. When it comes to partnerships, generally distributions are not going to be taxable to the extent a partner has adequate outside basis. So I'm saying a lot tonight, guys. I'm just trying to give you a brief overview. Finally, in Chapter 11, we're going to be talking about liquidating distributions. And Chapter 12 deals with partnership terminations. The bottom line is, that's my goal line. I'm not sure if we'll get to it, but we're going to try to get there. We're not going to get into chapters 13, 14, and 15, but we'll see how far we can get with the entire life cycle of a partnership. So those are grandiose goals on my part, but hopefully everyone's up for the task, and together we'll complete this journey. Any questions about logistics? Everyone's good? Go ahead.
Do you recommend taking income tax with partnership taxation?
You've got to be gritty to take both income tax and partnership tax at the same time. I don't know people's work schedule. It is intense to take both, and if you're working full time, truth be told. So just, I warn you, but not in a bad way, but just, you're going to be busy, very busy. Kevin?
More or less, when it comes to logistics, up to what chapter would be the first exam?
I'm not entirely sure. All right? I mean, my point would be, don't try to read too far ahead. I'm not sure if you're reading ahead will get you very far. If anything, read backwards. Once we cover the material, make sure you master it. So I'd rather have you go back and make sure you know it than go forward and be completely lost. All right, Kevin? You good? Go ahead, Sandra. It's the 7th class and 14th class. I haven't written that down. All right? Let's not get too far ahead of ourselves. All right, before I indulge in chapter 1, I always have to ask, people know, those who've had class, many of you are familiar faces. I get to ask, instead of what did you do this past weekend or what do you have planned for this weekend? Sandra remembers she told me I should go to the color factory, went to the color factory. This summer, did anyone do anything that you said noteworthy for the rest of the class to follow culturally? Anyone?
Culturally.
What did you do, babe?
I went to Argentina and Brazil, and I ate Amazonian ants.
Amazonian ants. Not the go-to for the vegetarian eating, but, and I will ask you, for those who want to follow your footsteps, were they good?
Yes. I think my brain was a little more scared than it should have been, but they tasted like lemongrass, and they were crunchy.
Okay? I don't know if anyone can beat that. I did go on a hike, I told my income tax class, Breakneck Ridge. If any of you have been, it's near West Point, New York. Very intense hike. So if you're into hiking and you want a mental and physical challenge, it's not far. It's about an hour and 15 minutes from here. Anything else anyone do? The whole summer you were just getting ready for partnership tax? All right, well, with that in mind, if anyone thinks of anything, don't be bashful. Let me know. Let the class know. Periodically, as the semester unfolds, again, I wish for you guys to indulge me and the class and share the good and the bad, all right, of things that we should all know about. You ready? Chapter 1, page 1. It's probably a famous saying by Buddha or someone else who said, every journey starts with the first step, right? All right, so we start with page 1. All right. Introduction to subchapter K. Guess what? If you turn to code section 701, what do you think it's entitled right above? Code section 701. Subchapter K. And if you look right above code section 301, what chapter of the code is that? Subchapter C. If you look at code section 1361, subchapter S. You wanted to look at trust and estates, that's subchapter J. So all these are important subchapters. The point is, the code is not arbitrary. The code section numbers, right, are purposely placed in the code, strategically placed. And the authors just point out that there's many a judge who, notwithstanding what Jay Solid said, you'll have judges say, gee, the area of partnership tax is a real quagmire, very challenging. All right, so at points in time, if you feel that it's tough, you should feel some solace that you're not alone, right? That this is tough material. And one of the things that makes it particularly challenging, we'll see throughout the semester, should a partnership be treated as a complete conduit entity, where we look at each of the taxation of each of the partners individually? Or conversely, should it, like a corporation, be treated as an aggregate entity? So there's this divergent path that subchapter K has that we will see periodically that partnerships are treated as complete flow-through entities on one hand, and on the other hand, they're treated as entities unto themselves. So because of that tension, it creates some issues in partnership tax. And some of the authors raise on page 3 rhetorically some questions that they're not going to resolve. And they're not going to resolve right here about this divergent world. Okay? Now, on page 4, the authors discuss introduction to choice of business entity. And this is very similar, by the way, for those who've had corporate tax. The introduction talks about, hey, choice of business entity, because one of the first things that virtually every client who I've ever had who's there for business planning will say, hey, what kind of entity should I conduct my business in, right? That's going to be standard fare in your practice, right? In yesteryear, in my opinion, it was somewhat straightforward, okay? Again, my opinion. Unless if the client was going public or thought that that was going to happen soon after they started, well, what is the go-to entity if you're going to go public? C corporation, right? So that's optimistic on the part of the client that they're going to be able to be a C corporation to go public. But if you have your smaller clients who maybe down the road might go public, but for the here and now, they aren't, what is going to be your answer? If I come, I have to knock on wood, right guys? Someone comes knocking and says, what kind of entity should we form? And your answer is?
S Corp.
No, it depends.
It depends, Minna, you say. On what?
It depends on the level of income that you generate.
Just to speak loudly, guys, we are a big class. So if you don't speak loudly, you're going to deprive John of hearing what you're saying, right? Right, John?
I would say it depends on the level of income. It depends on the level of liability that you incur in the business that you
Well, liability, I think, is going to be moved, right? Because A corporation, you have no liability. LLC, you have no liability. Profit motive, does that really matter? I mean, is that a factor? Because if you want me to make a generalization, everyone's hungry for profits, right? I don't care what kind of, the person who walks through your door, they want limited liability and they want to make lots of money, right?
I mean, who would own the business, whether it's going to be individuals or other entities?
Why would that have a bearing?
That would be.
That's going to
I mean,
change. Yeah.
you got to raise relevant questions. If you don't, I don't mean that badly, Peter, but when you're having a conversation with your client, you can't sit across right him and say, "Are you here to make money?"
Of course.
You know they're here to make money, right? Yeah, but you're not asking the question. I'm the client. So what do you want to know, and how is that going to color your decision? I make pancakes. I make cupcakes.
Do you have any other individuals with you?
What kind of individuals?
Other partners?
Investors, partners, family members? I have 3 other partners, or call them shareholders. I don't know. You tell me what to call
so you're
them.
between the LLC and the S corporation now, or a partnership. Yeah, you can have a partnership.
Okay, why not an S corporation?
Why not?
Why not?
Of course, yeah, you can go for this.
I'm the client.
How-
though. Which one should I go for? And why?
How much do you generate from your business?
What?
How much do you generate?
I generate $1 million. Does that
$1 million.
change your answer?
Oh yeah, of course.
Okay, of course. Where or how?
As corporation, you will be treated as a corporate officer. You might be on the payroll. That's going to save you some money. While in a partnership, you'll be taxed probably on the entire amount.
And if an S corporation, I won't get taxed on the entire amount.
Yes,
if
you
the
are.
S corporation or partnership each make $1 million, isn't someone going to bear tax on $1 million in both circumstances?
Yes.
So why did you say S corporation?
Because of the income tax. I mean, not the Social Security and Medicare.
So employment taxes
employment
might play a
taxes,
role.
yeah, that might, yeah, you might get that.
All right, so employment taxes might color an outcome, right? And let's just go through some of the things. These are some of the factors the authors raise. Let me just also put my cards in front, right out there. In yesteryear, most of us would shy away from C corporations, right? And we would say, well, you should form an LLC or an S corporation. And I'll tell you my own biases in yesteryear. Did I just hit something? I hope not. I'd probably say form an LLC way over an S corporation, okay? Now, because the way the world is today, what is the highest income tax rate on corporations?
20%.
21%. What's our authority for that? What code section? No, not code section 1. Code section 11, right? Code section 11. But the highest corporate tax rate is 21%. All right? So, having said that, and the highest income tax rate is what? 37%, right? Everyone agree?
Yep.
Highest tax rate on individuals, code section 1, is 37%. So, this is the first time in a long time, right guys, that the corporate rate is significantly lower than the individual rate. So that creates an incentive, right, to park money in corporations which are subject to lower tax rates. So you might say to your client, gee, you should consider forming a C corporation because your tax rate will be 21%, right? Everyone see that? Rather than taxable at 37%. Now getting the money out of the corporation, C corporation, causes a double tax, right? And I'm just going to recommend to MK, whoever MK, Michael, you may want to consider putting yourself on mute, okay? If you can hear me, Michael, it'd be great if you could put yourself on mute because we can hear some rustling.
Or we can drop
He
him.
did. He did. It's not very easy.
You did? I didn't see the microphone doing this.
No, it was selected for like a box and then
Okay.
disappeared, so it's-
We're good? We're good. Thank you, Michael.
He's mute now.
Yeah.
Okay, good. All right. So, right now, we exist in an environment where C corporations might, for several reasons, be inviting, with the caveat that when monies come out of a corporation, there is a double tax. Now, how are dividends often taxed? What's the highest tax rate? Well, under Code Section 1H, you have a 20% tax rate on dividends, right? Depending on your income bracket. Plus, you have under Code Section 1411, a 3.8% net investment income tax, right? So dividends are subject to two taxes, right? The income tax and the net investment income tax, agreed? When you combine the two taxes, they're slightly over, they're like 38.8%, something like that. So the difference now between C corporations and an LLC or S corporation is a lot less than it used to be. The only concern, well, one concern I have is depending on who is our next president, without getting into politics, which isn't going to be good for anyone in this room, but if Mr. Sanders becomes President Sanders, then you can imagine the corporate tax rate going up significantly, and were that the case, it's very hard. For those who've had corporate tax, you may remember there was a judge who once said it's easy to get into a lobster pot, and it's not too comfortable being in the lobster pot, and it's really bad getting out of the lobster pot. So corporations, once you're a C corporation, it is not easy, right? Getting out of a C corporation. A lot of tax implications. So my concern for my clients would be if I told them to, form a C corporation because at least for the time being, you'll be taxed at 21%. Next year, or if Congress were new president in 2020 and 2021, Congress enacts raises the corporate tax rate significantly. Well, not going to be easy. Your client's not going to thank you. So for me personally, I would still opt probably to go the route of a limited liability company. All right, let's talk about the reasons. First of all, they talk about, the authors beginning on page 5, talk about individual tax rates, talk about the net investment income tax on the bottom of page 5, and then at the very bottom of page 5, they talk about tax rates for C corporations and the double tax. Now again, for exam purposes, we're not going to see a single question about C corporations, okay guys? So rest assured. But this is just an outline of how C corporations are generally taxed. For those who've had corporate tax, most corporations pay no tax, not because they commit tax fraud, but most C corporations at the end of the year, if it's a closely held C corporation, they take it out, whatever income it earns, in the form of salary, right? So the corporation itself bears no tax. But those corporations which are large, like Amazon, Google, pick your large corporation, IBM, they do have the 21% tax and then the tax on dividends, which I just discussed. So I still say I personally would be scared of recommending C corporations for my clients. Page 8 talks about the fact there is a code section. C corporations do have this ability for certain C corporations for the shareholders to sell their stock at zero gain. But that we're going to see under Code Section 1202. Later in the semester, we're going to see Code Section 199A, the qualified business income tax deduction. Code Section 199A, the authors just give a very, very brief overview on page 8. They have what they call the bottom line on page 9. But the bottom line is, no one's sure. But again, from a prophylactic point of view, I would say you would probably want to stick with an LLC. And you may say, so you have your biases, you're teaching the course. Of course you are going to say LLC. I would have said it anyway, okay? So just know that, all right? Also, most small businesses, right guys, Do they make money, small businesses, when they first start? And most of them, notwithstanding the optimism, lose money. And if it's in a C corporation, those losses do not pass through. All right? So there's opportunities for the losses to pass through if it is a pass-through entity, be it an LLC or an S-Corp. Beginning on page 10, there's a discussion, a comparison between S-corporations and LLCs. And let me just say this. There are pros and cons to an S-corporation versus an LLC. For LLCs, the big pro, in my opinion, the flexibility. LLCs, you can put assets in, no tax. You can take assets out, generally no tax. Okay? So assets come in, assets go out, no tax. You can make special allocations. There's a lot of flexibility with how you allocate profits and losses. So that's the good news with respect to LLCs, the flexibility. With S corporations, they don't have that flexibility. Most of you are familiar with S corporations that there's a cap on the number of shareholders, now at 100. You can't have foreign investors in an S corporation. The investors in an S corporation have to be individuals. They have to be individuals. And there can only be one class of stock. Now keep in mind, it can be voting or non-voting, but it can only be, aside from that, it can only be one class of stock. So those are pretty significant limitations, but if I didn't mention it, the biggest limitation is, and I've had plenty of clients in this situation, when property comes out of an S corporation, appreciated property comes out of an S corporation, the normal rules of subchapter C apply. And what that means is that when property comes out of an S corporation, Code Section 311 applies, and there is a taxable event. So if you recall, partnerships, property can come out, property can go in, generally no tax. By way of contrast, well, in the case of subchapter S, Code Section 311 applies. So the flexibility that partnerships offer, tremendous. Minna was raising before, on the negative side, or I'll say on the advantageous side of S corporations, many of you may recall John Edwards. He's not going to be near and dear to the hearts of many of you. Does anyone remember who John Edwards was?
Presidential candidate.
Presidential candidate. Did he carry some baggage with him? What was his story? To say loudly.
Infidelity.
And what happened? He was on the campaign trail. And what happened? He had a love child. Why, his wife had cancer. It was not the prettiest situation. But why do I raise that story? What does John Edward have to do with S corporations, you might say? Fair question. John Edwards, he was, during the campaign, it raised the question is that he's an attorney, made lots of money in the form of an S corporation, took very little salary, so he minimized his employment taxes, all right, and took the rest out as a distribution, so that you can manipulate. It's fairly easy to manipulate the employment taxes with an S corporation by taking little in salary, so your salary is subject to the normal 7.65%. The employee pays the 7.65, the employer pays. But if you make $1 million and you only take $50,000 of salary, you pay the employment taxes on $50,000. The $950,000 you just take as a distributive share. There are no employment taxes. All right. You do have to possibly pay the net investment income tax, but you may not because it's an active trader business. So the point is, more games can possibly be played on an S corporation. So you got to think about that from your client's perspective. I still say LLC, I think, is the way to go. Minna?
But sometimes the IRS comes back and dispute your salary.
They could, but the IRS is stretched thinly. So the IRS could dispute your salary, but may not.
If you catch me.
All right?
But what is considered reasonable when they say reasonable?
Reasonable
Well, look at
salary.
Code Section 162. It is not clear what is reasonable, what is unreasonable. So we've had this discussion in the income tax.
I got it.
It should be the fair market value of your salary.
Reasonable compensation would be depending on the line of work. So
I mean, it's not always easy to pinpoint. That's a challenging issue.
and then what they do is they check national averages. That's what the IRS would do.
So you had a case on it?
Well, I don't know about a case.
Okay. All right. So anyway, I just want to point out that on page 14, the authors point out that 70% of all corporations are now S corporations, and approximately 70% of all partnerships are LLCs. Right. Now, beginning on page 14, there's a discussion of tax classification of business enterprises. In yesteryear, we'd spend a half a class on this discussion. In other words, is this partnership going to be taxed as a corporation because it has many of the attributes of a corporation, or is it going to be taxed as a partnership? The old test is spelled out on page 15, the first full paragraph, 10 or 11 lines down. There was a total of 6 factors, but the last 4 were what mattered. You would examine continuity of life, centralized management, limited liability, and free transferability of interest. And you would see if your limited liability company had more of these attributes, it would be taxable as a corporation. Your clients would not be happy. So there was a lot of attorneys and accountants who made lots of money trying to ascertain and write opinion letters whether or not particular entities were partnerships or corporations. Again, this is the old test. And a lot of ink was spilled on this. But ultimately, the IRS said, you know what? This is voluntary, meaning if you do the right hoops, you will get to the tax result you want. In other words, taxpayers, if they spent enough time, money, and energy, could produce the result the taxpayers sought. So the IRS sort of threw up its hands and said, you know what? We're going to make this voluntary. You're going to have a choice. You can be whatever you want to be, right? Reminds you of grade school, what your teacher said. You could be whatever you want to be. And the IRS essentially said, you form a business entity, and if you incorporate, you're going to be treated, guess what? As a corporation. Right? No one's falling off their chair when I say that, right? So the IRS made this proclamation. This is spelled out on page 16. It's called the writing about. So the authors just give us a little history on this, but the real rules, the current rules, and for exam purposes, I don't test history, right, guys? No history lessons here. You're only going to be tested on what is the law today. And on page 16, there's a description of check in the box regulations. And essentially, if you form a corporation, you are a corporation. And on page 17, the second full paragraph, if you're not incorporated, you're going to be treated as a partnership unless you elect to be treated as a corporation. So in other words, if you incorporate, game over, you're a corporation. If you don't incorporate, you're going to be taxed as a partnership unless you opt to be taxable as a corporation. Single owner organizations are essentially ignored for tax purposes, and we're not going to get into if you guys ever want. You can take international tax, but on page 17 and 18, they talk about foreign organizations and how they are generally taxed. But for our purposes, the key two paragraphs are on page 17, the first and second paragraphs. You incorporate, you are a corporation. If you don't incorporate, you're a partnership unless you elect otherwise. So the world is a lot easier than it used to be. Page 18 talks about the election. And I'll leave it at that. You don't have to, this is pretty straightforward. You can read it. If you have questions, you'll let me know. And by the way, since now most of you are here, I know some people might have had trouble finding us. Again, let me emphasize, if you have problems, reach out to me, all right? This is not something, don't wait for the day before the exam or the day of the exam and say, you know, now is my time. I'm going to ask someone the right questions or the wrong questions, whatever. If you get lost, the time to ask is sooner rather than later, okay? Just keep that in mind as the weeks go on here. All right. So, beginning on page 19, there's a discussion of what is a partnership. Is something a partnership or some other arrangement? And the authors, to introduce this concept, give us two cases. We have the Hodel case, the 1970 tax court decision, where we have taxpayers who are going to purchase, renovate, and sell certain residential property, and they want to know the character of that income. Sound familiar? Is it capital gains or ordinary income? And part of the question turned on whether or not this was a partnership or if they simply were making investments. And what the court holds here is that this enterprise constituted a partnership. There was a joint effort. These two taxpayers came together, and together they sought to make this property more valuable, and as such, to share the profits resulting from that effort. Accordingly, this was deemed to be inventory, and there was deemed to be a partnership. By way of contrast, if you look at the next case, Allison, we have an issue because if someone gets a distribution from a partnership, generally it's not taxable. I repeat, generally a distribution is not taxable. By way of contrast, in the Allison case, if someone is paid for their services, it is taxable. And if you look at the very bottom, page 21, says the question is whether there's a joint venture that's being created by the parties is essentially factual. It's special emphasis placed upon the intention of the parties. And then they mention 4 factors a little bit further in the paragraph. These attributes include a contract, express or implied that a joint venture be formed, the contribution of money, property, or other services by the venturers, and an agreement for joint proprietorship and control. And the most important, in my mind, is an agreement to share profits. And the agreement here said that this was a partnership. So at least on paper, it looked like this were a partnership, right? But remember, the IRS and the court can always look at the substance, not just the form. So even though you call yourself a duck or you call yourself a swan and you're a duck, you can't just say, I'm a swan if you're a duck, right? So by the same token, you can't just say, gee, I'm a partnership, I should be taxed as such. If you're not a partnership, you're not a partnership. And that was the case here. The taxpayer here, notwithstanding their title, it was deemed that this truly was not a joint venture, and there was a lack of profit motive with respect to this other party, and that they were really just being compensated for the services rendered. All right, so this is just getting a glimpse. This does not come up regularly in practice, guys, but once in a while, actually, just out of the blue last week, someone raised a question with me whether or not these parties that were entering into a tenancy in common relationship were a partnership or not. I can't make this stuff up, so I had to examine what was going on and if there was a joint profit motive. And I told them, based on everything they indicated, there was a joint profit motive, and they could not just try to put this round peg into a square hole. That they could not just pretend they were a tenancy in common. They were truly going to be a partnership. So once in a while, I can't tell you I get those kind of calls every other day, but these issues can come up. On page 24, you don't have to worry about series LLCs. I'm not that concerned. It's one way Delaware tries to attract business for itself. You can elect out of partnership status if you choose in limited circumstances, and sometimes people who engage in investment clubs sometimes elect to be not treated as partnerships. And there's a final point that if a husband or wife enter into a business relationship, even though there's two people, that's not necessarily a partnership. Code section 761F. So this way they're not forced. What kind of tax return do partnerships file, guys? Form 1065, right? So annually, if you treated a husband and wife as partners, even though they jointly went into business, it would force them to file an extra tax return. Extra tax return means an extra administrative burden on taxpayers. So Congress doesn't look to do that, penalize couples who enter into business together. I told my Monday night class, if I'm not here next week, you'll know why. I plan to be here. But I'm doing something in life that I've never done before, so I'll see if I survive. My son is doing a bike ride for autism research. And he said, Mom, Dad, you got to join me. Now, I'm not going to do the 100 mile. I'm doing the 50 mile, but somehow 50 miles equals 64 miles. I don't know how that math works. So I'm doing that on Saturday, and I'll see if I survive that. So I've been training, loosely training for that, but I have not done, I did 52 miles, not 64 miles 2 weeks ago. We'll see if anyone do any of these 100-mile bike rides and have any secrets? No one? All right, so I hope to have a story for you guys on Wednesday next week. We'll see if that comes to pass. All right, so page 26. Which of the following relationships are likely to constitute a separate entity for federal tax purposes? A, B, and C. Purchase a single parcel of land as tenants in common and hold the land as an investment. Okay? Is that going to be deemed to be a partnership?
Yes.
You say yes, Ramon? Julia, do you agree? Is that yes or no, Julia? Not sure? Dave?
Yeah, it's a partnership.
Well, just to point out, guys, there's a regulation, 7701-1A2. I'll repeat, 7701-1A2. It says mere co-ownership does not constitute a partnership. Mere co-ownership. It doesn't look like they're joining together, making improvements. They're just holding the property purely for investment purposes. So this probably would not give rise to a partnership. Okay? Same as A, except the land is subdivided. A, B, and C sell the lots. Does this seem more to be a partnership? Leon, what do you think?
So, land is divided.
Yeah, you gotta stream of consciousness. Say it louder.
Still thinking. I'm gonna 50-50. The A says no. I'm gonna go with B. It's yes. I have no authority.
Well, this is going to be Podell. This is the Podell case that we just looked at. Much more likely to be a partnership in this case because they're actively subdividing the land, meaning they're going to try to add value to it and then share the profits. Okay? Question C. Litigator and negotiator are attorneys who share office and a secretary. Each attorney services and bills his own individual clients. What does that seem like? Kevin, partnership or not?
No.
Not, right? That's just an office sharing arrangement, right? Not a partnership. Doctor will locate and purchase a suitable 4-unit building. Architect will remodel it. When the work is done, and the renovated building will be sold by the doctor, architect, real estate company, and architect will receive 25% of the net profits.
Partnerships.
Okay? In that case, does that seem like a partnership?
No, I think the commission is maybe I'm reading it wrong.
Well, compare and contrast that with question E. Would the result be different in D above if doctor and an architect agree the doctor will trade 3 units as rental property and an architect will receive 1 unit? So in question D, which one looks more like a partnership, D or E? D looks more like a partnership. D looks, because they're going to share profits. In question E, they're not sharing anything. They're just splitting the property. Okay, there's no shared profits in E. So question D has an aroma, right? How about question F? Fisher will purchase and operating a fishing boat. Lender will provide 10-year non-recourse financing to Fisher. The arrangement will be evidenced by a note secured by the boat, which will require repayment of the principal sum ratably over a 10-year period. In addition, lender will receive 15% of Fisher's net profits from the fishing operation each year of the arrangement.
Well, does he get a share of the losses as well? Is the question. Right?
Yeah,
Something about the loan in the
This is a secured loan of the commission.
right. So needless to say, B, you're raising a valid question. Usually there's an upside and a possible downside, but sometimes not. You can have a profits interest as a partnership and have no downside and still be a partner. So you can't just look for, oh, is there a risk? And the authors are trying to throw us, this has an aroma of both, right? If a bank lends money, typically not going to be considered a partner. Everyone agree? Not going to get a K1, they're not going to be considered a partner. But the authors are throwing a little bit of a curveball here because here the lender is participating, right? 15% of the profits. So I don't mean people know me long enough. I'm not looking to make your notes ambiguous, guys, but for your notes, this is not a go-to multiple choice kind of question. You can make an argument either way. All right? So the authors want to leave us thinking about this issue. Minna.
So
Do you know there's another Minna? How many times in a class do I get 2 minutes? There's Minna. Can you raise your hand for this Minna? All right? Like that's the first time ever I've got 2 minutes in the class. Go ahead, Minna.
Okay, so in this case, if it happens,
Just
how
speak
would you-
loudly because John can't hear you.
So in this case, if someone is participating in a business as giving you a loan, and he will share 10%, 15% of your profits.
Right?
If you succeed, how would you treat that? Like how?
I mean,
it's not a partnership. I don't 100%. This is not a partnership.
Well, it could be considered. The IRS
It's a
could
loan?
consider it a partnership because there's elements that they're sharing in the profits, but it could be considered bonus interest too. So I'm inclined to just leave it as bonus interest and keep it at that. That's my inclination. All right, I don't want to belabor this because we got lots of really important things to cover. Question 2. A long-winded question. It says the provisions of Code Section 7701 that define corporations and partnerships do not explicitly describe the elective classification regime. So anyway, let me distill this question. The authors are trying to say, was the Treasury Department authorized to issue check-in-the-box regulations? Okay, that's the takeaway from question 2. There's nothing in the Internal Revenue Code that specifically says that such an election is permissible, or that would allow the Treasury Department to issue these regulations. So the question is, are those regulations valid? And many of you, some of you may recall, some of you who are in the current income tax class, there's something called Mayo Foundation that says generally regulations should be deferred to unless they're arbitrary and capricious, right? It's not entirely clear if the Treasury Department had the authorization to promulgate these regulations. Remember, Congress has the right to write laws, correct? The Treasury Department is not vested with the right to write laws. So, again, here's another question that there's not a clear answer to, right? The authors raise it. To date, these regulations have been upheld, okay? So there's, in my mind, no question that these regulations should be upheld. It has made life for practitioners simpler. That doesn't mean at some point a court might think, gee, the Treasury Department wasn't authorized to write the laws, because there's nothing, again, Congress never wrote this should be an elective regime. Treasury on its own volition did this. Do not worry about publicly traded partnerships. Publicly traded partnerships are essentially taxable as corporations, all right? So that was one way taxpayers sought to skirt taxation as a corporation, creating these publicly traded partnerships. Publicly traded partnerships are taxable as corporations. So I have not been involved in any publicly traded partnerships. So let's just put that aside. Trust, for those who've had the trust and estates course, generally trusts are set to conserve and preserve property, right? Someone establishes a trust. Do they establish the trust for business reasons? And the answer is no, right? They set it up because their child, grandchild, spouse, they're concerned that they can't handle the investments, right? They're not done for business reasons. Suppose you have a business trust. Someone sets up a trust just to engage in business. Is that going to be treated as a trust under subchapter J? The answer is no. It will be taxable as what kind of entity? By default, it's an unincorporated entity, right? Unincorporated entities are generally taxed as how? Partnerships, right? Partnerships. But you don't see too much of this, because if anyone comes through my doors or your doors, you're never going to say, they want to form a business, you're never going to say, hey, I got this kind of cool idea, why don't you set up a trust, right? You're not going to say that, right? No one wants to be sued in this room, right? So you're not going to say that, right? Tax policy considerations, the authors just give you a quick review of the check-in-the-box regulations. Chapter 1, just as I say in income tax and just as I say in corporate tax, is not my go-to chapter as a professor to pull questions, okay? It's not, you know, I think it's well worth reading. It gives you a very good overview of the world of partnership tax and compares and contrasts it to corporations. So I do think it's worth your time to spend some time reading it. But for exam purposes, that's not going to be the chapter I go to and say, gee, let me pull 10 questions with you, right? So just know that in advance. Mena?
Just a quick question. How would you ask the question? Like, so when we read, we know exactly like, what am I looking for?
Well, the exam typically is a combination of true, false, multiple choice, and short answer, okay? And I try to be practical. And during the break, You can talk to people who've had my exam and say, how much truth is there? So let me not be the spokesperson. You'll get the grit from someone else. Okay, I'm going to be biased and tell you it's a very fair exam and all that other stuff, but my credibility is at stake.
We've been taking before.
Yeah, during the break. So you'll give him the good, the bad, and the ugly. All right. Yeah.
You said that if it's unincorporated, if it's an unincorporated entity, it's not a partnership.
So take the right note. If it's unincorporated, it is a partnership. It is a partnership. If things fall into place, I can't promise they will. At 7:30, we will take usually it's a 10-minute break. I'm hoping, because I know downstairs is not open, and I know getting food on a Wednesday night at a vending machines is no one's idea of fun. So bearing that in mind, at 7:30, and to give incentive to come as opposed to doing this on WebEx, there should be 16 pizzas that arrive at 7:30. So let's see if that happens, so that you guys don't go hungry here. All right. Next week, in theory, we'll see if this happens. The cafeteria downstairs should be open, so fingers crossed. But tonight, nothing's open, but you could get potato chips, but that doesn't really cut it. All right, chapter 2. You guys ready? Chapter 2. So this is very exciting because we're going to bear witness to the birth of our partnership, right? So it's a milestone. Generally, when you form a partnership, you have to worry, right? Because anytime there's a sale or exchange, most of you recall that Code Section 1001. Code Section 1001 is a biggie. If you give property to a partnership, and in exchange you contribute property worth $1,000, property you bought for $100 is worth $1,000, so you have an embedded gain of $900. You contribute it to a partnership, and in exchange you get a partnership interest. Well, Code Section 1001 says what? You have a $900 gain, right? Because notice, you're exchanging something, right? Sale or exchange gives rise to a realized gain. So anyone contributing appreciated property to a partnership, you have the risk of Code Section 1001 applying and giving rise to a gain. However, in the corporate area, what comes to the rescue? What code section comes to the rescue? 351, right? Code section 351, right? In the partnership area, what comes to the rescue? 721, right? Code section 721 comes to the rescue. Which is easier to qualify for? 721 or 751? Which one? 721. Why is 721 easier? Right, there's no Code Section 368C, which requires 80% control. Code Section 721 has no threshold for you to qualify, okay? So 721 is very easy. Now, 721, we have a bunch of code sections that you're going to have to come into play, okay? Just like the corporate area, you have, it could be individuals or you have two partners. They're going to contribute property to a partnership at 721 at the top, okay? And what ends up happening here is that when you contribute the property, you may want to open your code, never a bad idea. So if you open the code section 721, talks about no gain or loss shall be recognized to the partnership or any of its partners in the case of the contribution of property to the partnership in exchange for an interest. what basis will the contributing partner have? In my example, where you contribute property with a basis of 100, fair market value of 1,000, what basis will A or B have if they contribute that property?
100.
100. Why? Why? What code section? 722. 722. That they will have a carryover basis in their partnership interest. So if you contribute property with a basis of 100, fair market value of 1,000, your basis in your membership interest or your partnership interest will be $100. What will be your holding period? Sorry? It will be carried over all the time? It will only be carried over if it's what kind of asset? Capital asset or 1231 asset. Okay? You will only get a tact, T-A-C-T-E-D, tact holding period if it's a capital asset or 1231 asset. What's my authority for this? 1223.1. 1223.1 for the holding period. What will be the partnership's basis? Yes, the partnership's basis in the asset it receives. No, it's not fair market value, it's carryover basis. What's my authority for that? 723. What's its holding period? It's always tapped, no matter what the property. 1223.2. This, every one of these chapters, guys, can largely be reduced to a little graphic. Notice how Picasso how did I say? This is no Picasso, but you can do your own. But get every chapter down to a little stick diagram with the code sections. The authors on page 34 and 35 delineate exactly what I'm saying here. This is easy stuff for me as a professor to ask questions on an exam. And it's a question, not only easy for me to ask questions, but your clients will want to know. If they form a partnership, what's their basis? And by the way, your basis for A and B, is that called your inside or outside tax basis?
Outside.
That's your outside tax basis. The inside tax basis is what the partnership's basis is in the assets it receives. So get used to the lingo. Part of convincing your client you know what time of day it is to talk the right talk, right? So you can say to your clients, hey, your outside tax basis is going to be $100. Oh, and the partnership's inside basis is going to be $100 as well in the asset you contributed. Right? Just like in corporation, there's outside and inside basis. Good news is for those who've had corporate tax, this should be a bit easier. For those who haven't had corporate tax, good news is when you take it, it will be easier. All right? You, as the contributing partner, have a basis in your piece of paper known as the membership interest. That is the outside basis. Conversely, the partnership itself owns property, right? This property you contributed, that's the inside basis. And we need to know, Elijah, is what is your holding period in this piece of property, known as a membership interest? Have you held it for a day? Or did the property you contribute, was it a capital asset you've held for 10 years? If it's a capital asset you've held for 10 years, your holding period in that piece of paper is deemed to be 10 years. Okay? The holding period for the partnership is always tacked, always whatever your holding period was. All right. There's a revenue ruling 99-5. Not a hard revenue ruling to read. There's two different situations. If you look on page 36, you look at situation 1, B, who's not related to A, purchases 50% of A's ownership interest in the LLC for $5,000. A does not contribute any portion of the $5,000 to the LLC. A and B continue to operate the business of the LLC as co-owners. If you read this fact pattern, A originally held the entirety, was a single member LLC. And what you'll see, the holdings on page 37, for situation 1, that's going to be a deemed sale. By way of contrast, in situation 2, B, who's not related to A, contributes $10,000 to the LLC in exchange for a 50% ownership interest in the LLC. The LLC, so it's purely a contribution. It's going to use the contributed funds. In that case, situation 2, that's spelled out at the bottom of page 37, it's going to be considered as a joint contribution. And in situation 1 and situation 2, you'll see references to familiar code sections. Why familiar? You have code section 1001, 721, 722, 723, 1223.1, and 1223.2. These are important code sections. These are code sections you're going to have to know inside and out. Okay, guys? There's no getting around it. And we're going to go through a much more practical example. After we go through our practical example, my recommendation over Labor Day, guess what? Reread this revenue ruling, because once we go through that example or the problems, you're going to have a much easier time reading this revenue ruling. Okay, I promise. Okay, in the note that follows, I wouldn't worry about too much here. We're not going to worry about non-compensatory options. We're not going to worry about debt for equity exchanges. I will say this, and we're going to see a problem like this. When a partner contributes a promissory note, generally it's a non-event until the partner actually pays off all or a portion of the promissory note. Our important point, or what I'd like to get through before the break, is this problem on page 40, because this problem is really going to shed light on everything in chapter 2. So if you guys are ready, this is an important problem because why? This is one of those things you're going to see on the exam, midterm, final. You're going to see in practice. It's a very practical problem. Okay? Take a look at it. You have 4 people coming together to form a partnership. Okay? They're going to contribute different pieces of land, cash, all sorts of different property. And the author is on page 41 says, what are the tax consequences to each of the partners? And notice in question B, then we're going to turn the question around and say, what are the tax consequences to the partnership? So partners, and then the partnership. All right? Let me pause. Any general questions before we look at this problem? Giving a lot of information tonight. But guess what, guys? The entirety of this semester, I'm going to try to make sure that you get every dollar of your tuition's worth. So there's going to be lots of information coming your way. All right? So just come, lots of caffeine, okay? Come energized.
Just one question. Distribution, you said it's not taxable?
Generally, distributions are not taxable as long as they don't exceed your outside basis. All right, everyone ready? All right, let's look at the partners A, B, C, and D, and quickly go through the tax effects. And just bear in mind, most of you know that I don't go back to my office. I do not write down who gets answers right or wrong. just, I need to get, you know, I don't want to just hear myself speak for 3 hours. That sounds painful. So I call on you. If you know it, great. If you don't know it, life will go on. All right. So David, you want to be A, Ronald B, Nikki, do you want to be C? I'm sorry, your name is? Yeah. Aya. Okay, I got to get you on a tent card. But Aya, do you want to be D? Well, maybe I shouldn't ask if you want to, but can I ask you to be? Okay? So let's role play. David, any tax, and can you just pass this back to Aya? David, any tax consequences to you as taxpayer A for contributing this property? Because if 721 didn't apply, you'd be looking at a significant taxable gain on the land and the goodwill. Right, David, any tax? Why? 721. Okay, 721, no gain or loss? Okay. Before we get to a holding period, what's your basis in this piece of paper? Your outside basis. 100,000, Tom, you agree?
He's the land, right?
I'm sorry?
Your land?
He's contributing 2 things, the land and the goodwill. What's his outside basis?
30,000 for the land. And
Hey, Tom, he only has 1 piece of paper.
correct.
So what's his basis in that piece of paper known as membership
Oh,
interest?
I guess it would be.
Don't say the word gas. I don't pay $400 an hour for people to gas.
Alright, well, I guess I'll say 30,000.
30,000. What's your authority?
721.
721 talks about no gain or loss. It doesn't talk about basis. 722, right? Everyone agree? Code section 722, the outside basis here is 30,000, right? Okay? Everyone agree? If you don't, I say this belovingly, work your ass off this weekend, okay? Make sure you know this stuff, all right? If you don't know this, it's going to be really, this course really builds on itself, right? So it's going to be harder to progress. Yeah.
Can you explain section
722
722?
says it's a carryover tax basis. Okay? Whatever you contribute is your tax basis. Here the partner contributed property with a 30,000 and 0 basis, that becomes basis. What is, so 30,000 is basis. David, what's your holding period in that piece of paper? Use the word tact or not tact.
It's tax.
Tact. You gotta talk the talk and walk the walk. It's tact, right? These are 1231 in capital assets. So the holding period is tact. Right? Everyone agree? Goodwill and land are capital assets. B. Ronald. Any tax effects to you here? You say your outside basis is how much? Okay, what's your authority? Okay, his outside basis is 50,000. Now, what's your authority for the proposition that generally, if you dispose of an installment note, it gives rise to a gain, okay? If there's a disposition of an installment note, Code Section 453 says there is a gain. But I just call to your attention, the authors here are kind, and what do I mean by kind? Is if you look on page 33, the authors, for every chapter, will tell you specifically what code sections to read and what regulations to read, right? Good news, because they've really told you which regulations. You don't have to read all the regulations. If you look at that regulation 453-9C2, 453-9C2, everyone see it on page 33? That regulation, when you read it, it says that if you contribute an installment note to a partnership, it will not be considered a disposition event. It will not give rise to gain. All right, so I'm just calling that to your attention. So there is no gain. You might, and also, if you looked at Code Section 1245, if you recall Code Section 1245, if you dispose of 1245, it always gives rise to gain. But Code Section 1245B specifically says that if you contribute property to a partnership or corporation, no gain or loss, okay? So, again, we have Code Section 721, but we have other sections that help make sure this is not a taxable event. What is the holding period here, Ronald? All of it? Say it loudly. Well, I'll disagree with you. First of all, there's no tacking with the inventory. Everyone agree? So there's no tacking there. And I'm going to just call your attention on page 35. If you look at page 35, if you look at the material associated with footnote 12, that's at the end of the first paragraph. Let me read that sentence. For this purpose, recapture gain is treated as a separate entity which is not a capital or section 1231 asset. What does that mean? If you look at person B, that's you, Ron, how much is your recapture income? $20,000. Everyone agree? That's $20,000 of recapture income. Agreed? That's treated as a separate entity. So if you treat that recapture income as a separate entity, the equipment is a 1231 asset. It's worth $45,000. You take out $20,000 of recapture. How much is the equipment then worth as a separate entity? $25,000. The installment note from the land is considered a capital asset. So you have 25 for the equipment, 25 for the installment. The total there is 50. What about the inventory? That's 30 plus the 1245, 20, that's 50. So the holding period here would be 1/2 tacked, 1/2 not tacked. Let me repeat that. The 1245 gain is treated as a separate entity. So you have $20,000 that is treated as a non-tacked, is not tacked. You also have inventory, which is not tacked. What's 20 plus 30 is 50,000. The other property is all tacked. Let's move on to C. Nikki, C, any gain or loss here? So say it loudly. Why do you have 30,000 of ordinary income? Okay, everyone agree? C has $30,000 of income, ordinary income for services rendered, right? You don't get carryover. It's not the contribution of property. Okay? So it's going to be taxed at 30, right? Anything else? Why 35,000? I apologize? No, you always go with carryover. So what's the, okay? So under 722, right? It's going to be a $50,000 code section 722. Tacked or not tacked? All of it? Okay. The building and land, $70,000. So he gets his interest entirely is worth $100,000, right? So 70% would be taxed, 30% would not be taxed, because what he gets paid for services, right? It's a brand new holding period. So for your notes, I don't know what I just did. Hold on. You'd have 70% taxed, 30% non-taxed. How about person D? Aya? Did I say that correctly? Aya. Aya. What happens here? I'm sorry, say it again. Basis, right? So you have a $100,000 basis, right? 722. What's the holding period? What? It's cash. It's not a 1231 asset. It's not capital. It's a brand new holding period. Right? When you buy something for cash, doesn't your holding period start immediately? Technically, it starts the day after you acquire the property. Revenue rolling 66-7. Question B, what are the tax consequences to the partnership? Now, generally, does the partnership have any gain or loss as a result of receiving this property?
No.
No. It does not, right? So it's going to have assets. And we're going to have a capital account here. And the partnership is going to have two columns. Book value and adjusted basis. And it's going to have cash, accounts receivable, installment obligation, inventory, land, goodwill, equipment, building, land. And it's just going to take over the carryover basis, right? And the book value is the fair market value, right? And now we can look at A, B, and C. Their adjusted basis and the fair market value, or the book value of their membership interest. And this is just what we said. Right? I'm sorry, what is this is the land?
Yeah.
It's 10. I think the fair market value of the land is 10.
What's the final number?
Sorry, this is 400, 400. There's symmetry. It's not always going to be the case. Everyone in this room by next week should be able to look at this and understand exactly where these numbers come from. I am not pulling these out of thin air. If you guys do any work in partnership tax, this is just one of the fundamentals, period. You've got to know this stuff.
Professor, looks like you can't see you didn't share your screen. So you have Michael sent you something.
Michael sent me
If you
something.
go to the WebEx, it says you can't see you.
Okay, maybe during the break, and I apologize, Michael, I don't know how to share the screen. I don't know
Just
how.
go to WebEx and then share my screen.
Stop sharing. Let's see. I hope I didn't just. Did that share it, guys?
No.
During the break, if anyone knows how to share, I welcome that ability to share. Okay, so during the break, if anyone can come up here. Let me just make one more comment and then we'll take a break. Fingers crossed that there will be pizza out there. So question B, no gain or loss, carryover basis. In code section 1223.1, the partnership will have a carryover, will have a tax holding period in all these assets. Tax holding period in all those assets. Okay? That's under code section 1223.2. I'll have a tax holding period. The partnership will have a tax holding period. The question C, final question, then break.
1220, repeat that section.
1223.2. There's always a tax holding period. The holding period the partnership has in all of these assets. 1223.2 is taxed. Final question, although each of the partners contributes property of equal value, D transfers only cash while the other partners transfer property. Code section 704 C1A requires the partnership to allocate the pre-contribution gain or loss solely to the contributing partner when the partnership subsequently disposes of the property. What is the objective of that section? So let me just make an observation. You see the land that A contributed. You see it has an embedded gain of 40,000. Everybody agree? Everyone see that? Partnership A, partner A, who's contributing that part? Who should be taxed if the property is subsequently sold, say for 100,000? Who should be taxed on the gain? And the gain is going to be 70,000, right? Because the partnership has a basis of 30. Property sold for 100, right? Everyone agree? Yep. Who should be taxed? So the property, in my example, is sold for 100, basis of 30, gain of 70. Who should be taxed? Taxed. And what ends up happening is the first 40,000 get taxed to A, and the remaining 30,000, or 7,500, gets taxed to A, B, C, and D. Why does A get taxed on the first 40,000? Well, code section 704 C1A. Do you guys remember Lucas Fierro and the assignment of income doctrine? You can't allow people to manipulate the code so that people, remember, under A's watch, this property appreciated $40,000 in value, right? A must be taxed on that accordingly. 704 C1A memorializes the assignment of income doctrine, guys. Anything above that, if the partners have agreed to split profits 4 ways, that will be the outcome. All right, let's take tonight a 10-minute break, and if someone can help me share this with Michael and the others, that would be great. So my hope is that